Hello, everyone. My name is Phil Blancato, and I'm Chief Executive Officer of Latimer McDowell Asset Management. Welcome to the second quarter quarterly update and market commentary. For those of you for the first time looking at our video series, we just started this, and hopefully it'll be another way for you to communicate with us. Well, the second quarter was an interesting one. We saw it as a massive rebound from the first quarter. For those of you who may have kind of stayed in tune or listened to our other commentaries, you might remember that the first quarter came in at a negative 2.9% GDP, a terrible first quarter. And we staunchly believe it was a weather issue, and that in the northern part of the United States, it was extremely cold. And because of that, our economy as a country slowed down quite a bit. What we expected was in the second quarter was a very large rebound. So we saw the first quarter come in at negative 2.9. Our expectations for the second quarter will be roughly 3.5%. Imagine that vast spectrum from one side to the other. A significant amount of swing from gross domestic product. Well, that has a direct impact on the stock market. And in fact, the stock market was up nearly 5% for the second quarter. Our return year to date on the S&P 500 is now over 7%, and through today, nearly 8%. When you look at the political and economic landscape, there's a number of things that are holding the economy back. But by and large, things are better today than they were a year ago. Let me start off by saying the reason why the stock market is doing so well is the consumer. The consumer, for the most part, is in pretty good shape. We've seen unemployment come from 10% down to 6%. One of the negatives is that as the unemployment numbers gone down, we do know that the participation rate, the number of people who are actively working in the workforce, has also gone down. And that's because baby boomers are retiring. Good for them. They're on to their next phase of their life. But it does affect the number of people working. That's part of the reason the number has come down. However, the other part is our economy has created 200,000 new jobs every single month for the last 5 months. Those are real jobs and real people going back to work. Some of them part-time, some of them lower-paying jobs, but still a positive, and that's part of the reason why the stock market's up. The other part we've seen is that the consumer is in better shape from a return standpoint. They're actually earning more money. We're seeing wages going up by around 2%. We want that number to be 3%. Maybe even 4%, but for today at 2%, it's certainly a step in the right direction. And finally, less debt. The consumer today has a heck of a lot less debt than they did about 5 years ago, about $1 trillion less debt. Couple that with profits. U.S. corporations continue to do exceptionally well. Our profits for the first quarter were about 5% on average. For the second quarter, they're nearly 10% from an earnings standpoint. 10% increase in earnings year over year. And that's partially because of this rebound in the second quarter, and partially because the Federal Reserve continues to be very friendly towards U.S. corporations. How are they doing that? They're keeping interest rates artificially low. Perhaps you've heard of the quantitative easing program, and it's gone from $85 billion down to $35 billion. That's the amount of bonds our federal government buys every month. Well, that number's come down, but interest rates are still low. And because they're low, corporations can borrow inexpensively, and that's a direct driver of profits. So the stock market's done well because of the consumer, and it's done well because of profits can stay up. Part of those profits are because of low interest rates. On the other hand, the bond market has done much better than we expected. In fact, last year we saw interest rates rise from 1.5% to 3%. This year we expected that to stay about 3%, and maybe even go as high as 3.5%. When in fact it's reversed. The reason why we've seen interest rates go from 3.5% back to 2.5% was because, one, that first quarter was pretty tough. And two, European bonds continue to actually pay very low rates of interest rates. You see, Europe has made a decision to bail itself out at any cost. And because of that, there's been a rush into European bonds. However, the United States is actually offering yields that are higher than Europe and are safer. So now we've seen a rush back into U.S. bonds, which have pushed rates down. A little unexpected. Also, the federal government continues to buy, not as much as it was, but continues to buy bonds every single month. It's a little unknown fact, but our annual budget deficit has come down. So even though the Federal Reserve is buying less bonds every month, it's actually still having a pretty profound impact on interest rates. We don't expect that trend to continue. We think that by the end of the year, interest rates could be back up around somewhere around 2.5%, maybe 2.75%, maybe 3%. But we understand that rates should go higher. I believe that rates should go higher. And we look at our fixed income and we position from the idea that if we globally diversify our fixed income positions, we'll be okay. And that's exactly what we've done along the fixed income part of the portfolio. When you think about alternative investments, you think about how successful our alternatives have been, MLPs are something that comes to mind. There is a revolution that's going on in the United States. It's a revolution around energy. And that energy impact has not only buoyed U.S. manufacturing, but it's also got us a whole new industry creating new jobs for folks. We believe we can capitalize on that by owning MLPs in a portfolio which are master limited partnerships or pipelines. So alternative investments have done quite well for the second quarter as well. And this energy renaissance the United States is going through is having an impact not only on corporate profits, but creating new industry. So in conclusion, there's a couple things I'll talk about as far as what we expect the rest of the year. Some of the negatives I haven't touched on, but I will briefly wrap up with them. There is a geopolitical situation going on out there in the world. There is a situation around Russia. There's a situation around Ukraine and Russia. What's going on in Palestine and Israel? What's going on in Iraq, Iran, and Afghanistan? These are all significant geopolitical events. But they're not new. We've had problems with Russia for a long time and problems with Iran, Afghanistan, and Iraq for a long time. So what do those situations do? Well, they bring volatility into the marketplace. And we expected that this year. Our expectations were the S&P to do somewhere between 8 to 10 to 12% this year. And we're right in that range right now. We have a political season coming up with a potential change down in Washington from Republican to Democrat. From Democrat to Republican in the Senate. We've got some geopolitical events, and all those can be hindrances to the U.S. economy and to the global economy. So they're negatives. The unemployment picture in Europe is still very poor. Europe is just now getting out of a recession. The U.S. unemployment picture better, but still some issues. So when you think about it on whole, the economy is in better shape today than it was last year. It's growing by around 2%, more or less. We still have a ways to go. We're not there yet. We would expect that the positive factors I already mentioned as far as profits in the consumer will be stronger than the negatives around unemployment and geopolitical situation. But we do think the market will continue to be volatile the rest of the year. We've got some hurdles we need to get through and hope that the year will close itself out pretty well after we pass this next election season. So with that, hopefully this was a little bit of an understanding of where we think the market's going, what we expect to happen. And of course, if at any time you have any questions or concerns, please contact your financial advisor. They will then reach out to us and we'll try and answer any question you might have. Thank you for the trust and confidence you put in us. We look forward to meeting you and hearing from you soon. Thank you. Take care.